I'm Larry Walther, and this is principlesofaccounting.com, Chapter 5. In this module, we will look at closing entries for the merchandising business that uses a periodic inventory system. The objective of closing is to close revenue and expense and dividend, all the temporary or nominal accounts, to close those out to retained earnings at the end of an accounting period. We've seen this in a previous chapter. But now that we have a merchandising business using a periodic inventory system, we've introduced a whole another series of accounts: purchases, freight in, purchase returns and allowances, purchase discounts, sales discounts, sales returns and allowances. There's a number of additional accounts that reflect activity for a period of time, temporary or nominal accounts that additionally need to be closed out. Another thing to consider is the issue of inventory. Under a periodic system, we're not debiting inventory every time we buy inventory. Remember, we're debiting purchases. Also, remember, we're not crediting inventory when we record a sale. We're only recording the sales side. And so I would ask, what is in the inventory account? The answer is the beginning of the year balance. We have not touched it or affected it during the entire year. So another thing we need to do in the closing process is to update our inventory records, our inventory account of the general ledger, to reflect the actual ending balance. And so let's look at these closing entries. We would find all of the nominal accounts or temporary accounts that have credit balances and debit those. That's the usual, the expected suspect, sales, but it also now includes purchase discounts and purchase returns and allowances. And notice I'm throwing in one more item. I'm debiting inventory $91,000. In a previous module, we looked at an income statement and we saw this company had $91,000 of ending inventory. So here now I'm establishing that ending inventory with a $91,000 debit to the inventory account. I'm crediting $861,000 income summary. If I look at closing all of the temporary accounts that have debit balances, now I'm crediting sales discounts, crediting sales returns, crediting purchases, freight in, and so forth. But also notice I'm including a credit to inventory. This was the beginning of the year balance for this company. They had $115,000 in the general ledger, and I'm now assuming that to be sold. So what I've done with the first entry was set up the ending balance of inventory, and this second entry is removing the beginning balance. The inventory account now holds the right amount of inventory. The ledger account corresponds to the actual ending inventory on hand, and the income summary had a debit and a credit, and the net of those reflects the net income of $11,000 for the period. If you're concerned about if this is a correct amount, you could go back and look at the previous video where we saw the income statement for this company, or look at the textbook, it's in there as well. You can see the $11,000 of net income is the amount that's being closed to retained earnings. Bear in mind that the income summary, it captures the cost of goods sold because we included adjustments for beginning inventory, for net purchases, as well as establishing the ending inventory amount.